Okay, so you want to own a parking garage. Find a piece of land, pour some concrete, put up a few signs. Collect money from every driver who pulls in. No inventory to manage, no staff delivering a complex service, no product that expires or breaks. You own the ground, and the ground doesn't move. Sounds like one of the cleanest businesses in commercial real estate. The problem is what sits underneath that clean surface. What it actually costs to build the structure. What happens when the city around it changes? Why some parking garages generate extraordinary returns for decades? Why others, sitting in what looks like the perfect location, bleed money slowly until the owner hands them back to the bank. Here is where the economics actually start. The first thing to understand is that a parking garage is not one business. It is three completely different businesses wearing the same concrete shell. Which one you are actually running depends almost entirely on where the structure sits and who owns the land beneath it. The first version is the transient garage, the kind attached to a downtown office tower or a hospital complex, where drivers pay by the hour and nobody has a reserved space. The second is the monthly contract model, where a fixed pool of commuters or residents pays a flat rate every month for guaranteed access. The third is the event-dependent garage, the kind built adjacent to a stadium or an arena. That may sit nearly empty 5 days a week and process thousands of cars on the sixth. Each version has a completely different rent cost structure, revenue profile, and risk exposure. Most garages are some combination of all three. Before any revenue arrives, you have to build the structure. A parking garage is not a cheap building. A conventional cast-in-place concrete structure in a major American city costs between $25,000 and $35,000 per parking space to construct. A single-level surface lot is obviously far cheaper, but land in the locations where parking demand justifies a garage is never cheap enough for surface parking to make financial sense. A 500-space downtown garage might cost between $15 million and $20 million to build before you have accounted for land acquisition, permitting, foundation work in difficult soil conditions, or any ground floor retail built into the base of the structure. In cities with unusually high construction costs, those numbers move considerably higher. San Francisco, New York, Bow, Stone have seen parking structure costs exceed $50,000 per space for projects in dense urban cores. Land is where the economics of parking ownership get complicated very quickly. In most of the highest demand locations, the land beneath a parking garage is worth more than the garage itself, often dramatically more. This creates a structural tension that defines the entire business. You are sitting on an asset whose highest and best use, in the language of real estate appraisers, is almost certainly not parking. A piece of land in the downtown core of a growing city is, from the perspective of a developer, a future office tower or a residential building or a mixed-use project. Parking is what you do with the land while you wait for the real development to happen, or while the financing for something bigger doesn't quite come together. Investors who buy existing garages in appreciating urban markets are frequently buying an option on the land underneath, not a permanent cash flow machine. That distinction matters enormously when you try to underwrite the business. If you're buying a garage as a long-term income-producing asset, you need to believe the land will stay in parking use long enough to justify the price. If you're buying it as a land play, the operating income from the parking is essentially a carrying cost offset while you wait. The worst position is paying a price that assumes the land's full development value while also expecting the parking revenue to service the debt. That combination rarely works. It is behind a significant share of the distressed parking assets that trade at steep discounts. So set aside the land question for a moment and look at the operating economics of a mature garage in a stable location. A 500-space downtown transient garage in a mid-tier American city might generate gross revenue somewhere between $1.5 million and $3 million per year, depending on the market rate for hourly parking, the average length of stay, the occupancy level across different times of day. That number sounds straightforward until you start working through what it costs to produce it. Staffing a booth or maintaining the automated payment technology that has replaced the booth in most modern garages runs into the hundreds of thousands of dollars annually. Electricity for lighting, ventilation, elevators, and payment kiosks is a large and non-negotiable line item. Liability insurance, on a structure where vehicles are damaged, people fall. Theft occurs regularly, is expensive and getting more expensive. Then there is maintenance. That in a parking garage is more relentless than most owners anticipate before they own one. Concrete structures exposed to vehicles, weather, road salt. The mechanical stress of thousands of cars driving over expansion joints every day deteriorate at a rate that requires constant intervention. The single largest maintenance cost in any aging parking structure is concrete repair. Water penetrates through cracks, reaches the reinforcing steel, causes the steel to rust. As the rust expands, it fractures the surrounding concrete. This process, called spalling, is not a cosmetic problem. Left unaddressed, it compromises the structural integrity of the deck. Repairing it requires closing sections of the garage, cutting out deteriorated material, treating the steel, ching the surface with specialized compounds. For a 30-year-old garage in a northern climate where roads are salted through winter, annual concrete repair budgets of $100,000 to $300,000 are not unusual at some point in the life of a parking structure. The repair bills stop being annual line items and become a capital event. A full deck waterproofing and concrete restoration project on a 500-space garage can cost between $2 million and $5 million, depending on the severity of the deterioration. These projects don't generate any additional revenue. They simply prevent the building from becoming unusable. This is the capital expenditure cycle that surprises investors who model parking garages primarily on their revenue yield without stress testing what it takes to maintain the physical asset over a 20 or 30-year holding period. What does the revenue model actually look like at the hourly level, in a well-located downtown garage serving office workers and retail visitors? Peak demand runs Monday through Friday from roughly 7 in the morning until 6 in the evening. The garage fills to 80% or 90% capacity during those hours, then empties significantly in the evening and on weekends unless there are restaurants, entertainment venues, or a hospital nearby to sustain overnight demand. This demand pattern means the asset is earning most of its money during a relatively compressed window. A garage that charges $20 for a full day processes 400 cars on a typical weekday. Runs at 60% of that on weekends might generate gross revenue of around $2.2 to $2.5 million per year. After operating expenses, that same garage might produce net operating income of $800,000 to $1.2 million. That is the number against which the purchase price is measured. When investors value a parking garage, they typically apply a capitalization rate to the net operating income. The cap rate is the expected annual return the buyer requires from the asset, expressed as a percentage of the purchase price. A lower cap rate means the buyer accepts a smaller annual return, usually because they believe the asset is lower risk or has strong growth potential. A higher cap rate means the buyer demands more income per dollar of purchase price, reflecting higher perceived risk. Downtown garages in major cities with long operating histories have traded at cap rates between 5% and 7%. Apply a 6% cap rate to a garage producing $1 million in net operating income. The implied value is roughly $16.7 million. That math sounds clean, but it ignores the variable that makes parking uniquely difficult to underwrite: the asset's vulnerability to structural demand shifts. Here is the problem that makes parking different from most commercial real estate. The demand for a parking garage is not just a function of the neighborhood around it. It is a function of the transportation infrastructure around it, and that infrastructure can change. A downtown garage that serves 500 commuters every weekday because there is no viable transit alternative to their office building is a fundamentally different business the day a light rail line opens 2 blocks away. This is not a hypothetical. Cities across the United States have invested heavily in transit expansion over the past 2 decades. In several markets, parking garages located near new transit stations saw weekday occupancy drop by 20% to 35% within the first few years of service opening. The reverse is also true in certain markets. Some garages that were built adjacent to transit hubs, expecting to serve park-and-ride commuters, have dramatically outperformed their original projections because transit usage in the surrounding region grew faster than anyone modeled. The general rule is that parking demand does not move gradually. It tends to stay stable for years, and then shift quickly when a single large change arrives, whether that change is a new transit line, the closure of a major employer, the opening of a sports venue nearby, or a zoning change that converts surface lots around the garage into competing structured parking. What about the monthly contract business? This is generally viewed as the more stable revenue stream within a parking operation. This was because the tenant commits to paying a fixed amount regardless of whether they actually use the space on a given day. a monthly parker paying $200 to $350 per month. That is typical in mid-market American cities, generates predictable cash flow that operators can model. Large employers near a garage are the most valuable source of monthly contracts. This was because a single human resources department might be responsible for dozens or hundreds of monthly accounts. Losing a corporate account when a company relocates is, accordingly, one of the larger single event risks in the monthly contract business. Operators who are heavily concentrated in 2 or 3 of those per passionate might be responsible for dozens or hundreds of monthly accounts. Losing a corporate account when a company relocates is, accordingly, one of the larger single event risks in the monthly contract business. Large corporate accounts are running a more fragile business than the raw revenue number suggests. Airports represent a special case in parking economics, and it is worth understanding why. The parking assets at major American airports are among the most profitable in the industry, not because the hourly rate is dramatically higher than downtown, though it often is, but because the captive nature of the customer is extreme. If you are flying out of Dallas-Fort Worth International Airport and you drive yourself to the terminal, you have exactly one option for covered parking. You pay what the airport charges. Dallas-Fort Worth generated $251 million from parking and ground transportation in fiscal year 2024. That figure reflects a monopoly position that no private downtown garage owner can replicate. Even airports that have introduced rideshare competition have retained enormous parking revenue because a meaningful share of travelers prefer the simplicity of driving and leaving their own vehicle regardless of cost. The technology side of parking operations has changed considerably over the past decade. It has changed the cost structure in ways that are not always visible from the outside. Automated payment systems, license plate recognition, dynamic pricing software. Reservation platforms have collectively reduced the need for human cashiers at most modern facilities. A garage that employed 15 to 20 people across its operating shifts 10 years ago might run today with 2 or 3 on-site staff supported by remote monitoring. Labor cost reduction is real, but the capital required to deploy and maintain this technology is also real. The systems require ongoing licensing fees, software updates, hardware replacement cycles that create a different cost profile than the labor costs they replaced. Dynamic pricing, in particular, has had a meaningful impact on revenue in garages that have deployed it well. The logic mirrors what airlines and hotels have done for decades. When demand is high, prices rise automatically. When demand is soft, prices fall to attract price-sensitive drivers who might otherwise park elsewhere. A garage near a convention center that would historically have charged a flat $25 on an event day can now charge $45 or $55 when demand data shows the area filling up. Then drop to $12 on a slow Tuesday afternoon to capture commuters who might otherwise have taken transit. Operators who have implemented dynamic pricing report revenue increases of 15% to 25% over comparable periods when pricing was static. The catch is that the software requires good data, accurate demand, and forecasting. Some tolerance for customer complaints when prices spike sharply on busy days. One of the underappreciated revenue levers in a well-run parking operation is the ground floor retail or commercial space built into the base of the structure. Many parking garages built in urban cores over the past 3 decades were designed with leasable retail frontage at street level, precisely because a blank concrete wall along a retail corridor is a dead use that destroys the economic value of adjacent properties. A parking garage with 2,000 to 4,000 square feet of leasable retail space facing a busy pedestrian street might generate $80,000 to $200,000 per year in additional rent on top of the parking revenue. That space is not large, but because the structure behind it is already built and the marginal cost of the retail shell is low, the income it produces drops almost directly to the net operating income line. The ownership structure of parking garages varies considerably. The structure matters for how the economics actually work in practice. Some garages are owned independently by private operators, others are owned by the buildings they serve. With parking revenue treated as an ancillary income stream attached to an office tower or residential development, others are publicly owned, operated by municipal parking authorities whose mandate is a mix of generating revenue and managing transportation behavior rather than pure profit maximization. And a growing share are owned by parking-specific real estate investment trusts, or large operating companies that run hundreds of facilities across multiple markets simultaneously. The large-scale operators have structural advantages that smaller independent owners cannot easily replicate. They can negotiate better rates with insurance carriers by spreading risk across a broad portfolio. They can deploy technology across hundreds of locations and amortize the development cost over a much larger revenue base. They can cross-sell monthly contracts to corporate clients who operate in multiple cities. And they have the analytical infrastructure to identify which assets in their portfolio are underperforming relative to their market potential and apply operational fixes systematically. The independent operator owning one or two garages is competing against this at a disadvantage on almost every non-location variable. What does distress look like in a parking garage? The pattern is usually gradual rather than sudden. Occupancy declines as competing facilities open or as demand in the surrounding area softens. The operator responds by cutting rates to stay competitive, which compresses margins. Deferred maintenance starts accumulating because the cash flow no longer supports the capital budget. As the physical condition of the facility deteriorates, the price-sensitive customers who remain become more willing to use a competing garage that looks cleaner and better maintained. Occupancy falls further. By the time a lender starts paying close attention, the garage may be generating enough cash to cover operating expenses, but nowhere near enough to service the debt that was placed against the asset at purchase. ACE. The lender's options are limited. Foreclosing on a parking garage and selling it into a market where the property's problems are visible is rarely a path to recovering the loan balance. The valuation question becomes particularly acute during periods when urban real estate markets are moving in contradictory directions. In many American cities over the past decade, the value of land in the urban core has risen significantly, while the demand for parking in the same locations has stagnated or declined because of rising rideshare usage, improved transit options, remote work patterns that have reduced peak commuter traffic into central business districts. This divergence creates a situation where the garage is worth more as a development site than as a parking business. That is valuable information for an owner thinking about their exit, but creates a meaningful problem for anyone who paid a parking business multiple to acquire it and needs the parking income to justify this price. Rideshare's impact on parking demand is real, but has proven more uneven than early projections suggested. When Uber and Lyft scaled rapidly between 2012 and 2018, many parking operators and analysts expected steep declines in urban parking revenue. What actually happened was more complicated. In some markets, airport parking declined moderately as travelers substituted rideshare for driving. In others, the effect was minimal because drivers who use their own cars to the airport tend to be doing so for reasons unrelated to price, such as traveling with large amounts of equipment or luggage, or simply preferring the convenience of having a car at the destination airport on return. Downtown transient parking showed mixed trends, with some markets seeing meaningful declines and others remaining broadly stable. The deeper structural question for parking owners looking 10 to 20 years forward is autonomous vehicles. If self-driving vehicles become widely deployed in urban areas within the next 2 decades, the demand for centralized parking infrastructure could change substantially. A vehicle that can drop you off and then drive itself to a lower-cost peripheral location to wait, or return home entirely, eliminates the need for downtown parking for that trip. Various consultancies and urban planning firms have produced estimates of parking demand reduction under different autonomous vehicle adoption scenarios. The range is enormous. Some scenarios project demand reductions of 40% to 60% in dense urban cores by 2040. Others project far more modest changes because of the slow turnover of vehicle fleets and the uneven pace of infrastructure development. Nobody knows with confidence which scenario is correct. What that uncertainty means practically is that parking garages with long remaining useful lives face a stranded asset risk that most other commercial real estate categories do not face to the same degree. A well-located office building can be repositioned as residential. A retail center can be converted to mixed use. A parking garage is a concrete structure optimized for a single purpose. Repurposing it into residential or office space is technically possible, but mechanically difficult. This was because parking garage floor-to-floor heights, structural bay sizes, ramp configurations are all designed around vehicles, not people. Conversions have been completed in a handful of markets, but they are expensive and require the right structural geometry to work at all. Most parking garages built after 1980 do not have the structural characteristics that make conversion straightforward. The most defensible parking assets in this environment share a few common characteristics. They sit in locations where alternative parking options are severely constrained by land availability. They serve demand that is tied to physical facilities rather than to commuter patterns, meaning hospitals, airports, sports venues. They have been maintained adequately so that major capital events are predictable rather than immediate. And they are owned at a basis that reflects the current operating environment rather than peak parking demand from a prior decade. Garages meeting all four criteria do exist, and they continue to transact at reasonable valuations. The ones that fail to meet two or three of those conditions are trading at discounts that reflect the difficulty of underwriting their future. What a parking garage ultimately is, stripped of the specific numbers, is a fixed infrastructure asset serving a demand that is geographically constrained in the short term but structurally uncertain over longer horizons. The income it generates is real and in many locations significant. The costs it carries are higher than they appear from the outside, and the value it holds is inseparable from what the land beneath it is worth and what the city around it decides to become. Investors who have made money in parking garages over the long run have generally been people who understood the land story, the market trajectory, the maintenance reality with equal clarity rather than leading with the revenue yield and hoping the rest would resolve itself.